Most people think the economy is growing. They're wrong. We are cannibalizing the future to pay for the present. Global debt has surged beyond 300% of global GDP, more than $330 trillion, a global economy increasingly dependent on borrowed money. To repay it, humanity would need to work for over 3 years, spending nothing. No food, no energy, no medicine. For 40 years, markets ignored the risk because cheap money made the impossible feel sustainable. Debt stopped looking like a burden. It became the fuel driving the entire system. But the rules of the global economy are beginning to change. We are now witnessing a rare macro collision, record debt levels meeting rapidly rising interest rates. Historically, when the cost of money rises faster than the capacity to service it, systems don't just slow down, they break. The era of easy money is over, and the strategies that built fortunes over the last decade may become liabilities in the next one. This is the story of the Great Gravity Reversal. This is the moment the operating system of the modern global economy begins to lose power. After World War II, the global economy entered a rare phase of stability and reconstruction. Countries borrowed heavily to rebuild infrastructure: roads, ports, housing, power grids, and factories. But this debt financed productive growth. Borrowing expanded industrial capacity, trade accelerated, populations grew, economic output increased faster than the debt itself. And that distinction matters, because in this era, debt mostly created real economic expansion, not just higher asset prices. For nearly 2 decades, debt and growth moved together. The system felt balanced. By the late 1970s, global debt had reached around $7.5 trillion. At the time, that figure seemed enormous. Today, it looks tiny. But beneath the surface, pressure was building. Inflation accelerated, oil shocks destabilized economies, currencies weakened, and the post-war financial order began to strain. Investors started learning an important lesson. When inflation rises, debt becomes harder to control. A turning point was coming. The 1980s changed how the world thought about debt. In the United States, President Ronald Reagan introduced major tax cuts while increasing military spending. The theory was simple: lower taxes would stimulate growth, and growth would eventually offset rising deficits. But deficits expanded rapidly. Government borrowing accelerated. At the same time, Federal Reserve Chairman Paul Volcker raised interest rates aggressively to crush inflation. Money became expensive. Recessions followed. Financial pressure intensified across the global economy. And this forced a structural shift. Financial deregulation spread across Western economies. Credit became easier to access. Debt stopped being viewed purely as a risk. It became a tool for growth. Households borrowed. Corporations borrowed. Governments borrowed. And, increasingly, markets rewarded leverage. The 1980s also marked the beginning of a major economic transition. The global economy slowly shifted from industrial expansion toward credit-driven expansion. Financial markets became more influential. Asset prices became more sensitive to interest rates, and central banks gained enormous power over the direction of markets. Between 1980 and 1985, global debt nearly doubled. But the real transformation was psychological. The world discovered that borrowing could stimulate growth faster than productivity alone. And once that process began, it became difficult to stop. By the mid-1980s, debt was no longer just supporting the economy. In many ways, it had become the economy itself. Wall Street didn't simply lend money anymore. It transformed debt into financial products. Debt was packaged, rated, sold, and distributed across the global financial system. A massive, interconnected structure emerged. Like financial Jenga, Every layer depended on the stability of the layer beneath it. At the same time, regulators increasingly trusted markets to self-correct. Federal Reserve Chairman Alan Greenspan became the face of this era, one of market confidence and monetary intervention. And each crisis reinforced a new pattern. When markets weakened, interest rates fell. When rates fell, borrowing expanded further. Over time, debt stopped merely financing growth. It began inflating valuations. Stocks, housing, private equity. Assets rose not only because profits improved, but because capital became continuously cheaper. This became the defining macro trend of the modern era. Cheap money encouraged risk-taking. Cheap money expanded leverage. Cheap money pushed investors further and further out on the risk curve. Slowly, markets became dependent on liquidity itself. Investors stopped asking, "Is this asset fundamentally valuable?" and increasingly asked, "Will the liquidity continue flowing?" By 2008, global debt surpassed $100 trillion. Yet the system still appeared stable. Until suddenly, it wasn't. September 15th, 2008. Lehman Brothers collapses. Within hours, global credit markets begin freezing. Banks stop trusting one another. Liquidity evaporates. The financial system starts seizing in real time. Governments and central banks face a decision that defines the modern investing era: allow the system to collapse or intervene aggressively. They intervene. Trillions are injected into the banking system, interest rates fall toward zero, and central banks begin quantitative easing at historic scale. Then, something even more important changes, psychologically. Markets internalize a new assumption. During systemic crises, central banks will step in to stabilize the system. This becomes known informally as the Fed put, and it fundamentally changes investor behavior. Because if downside risk becomes partially socialized, then taking greater financial risk becomes rational. This is the moral hazard moment. The era of modern liquidity-driven markets truly begins here. After the financial crisis, the world entered one of the most unusual monetary environments in modern history. Near-zero interest rates persisted for more than a decade. The logic was straightforward. Cheap money would stabilize markets, support lending, and restart economic growth. For a time, it worked, but it also changed how investors priced almost everything. When rates are extremely low, future profits become more valuable in today's dollars. That helped drive massive expansions in stock valuations, venture capital, technology investing, private equity, and real estate. An entire generation of investors experienced markets during an abnormal monetary regime: falling rates, abundant liquidity, and aggressive central bank support. Many began assuming those conditions were permanent, and the world became increasingly dependent on debt expansion to maintain growth. Governments borrowed because money was cheap. Corporations borrowed because capital was nearly free. Investors borrowed because asset prices kept rising. And nowhere was this more extreme than in China. While Western economies recovered slowly, China became the world's credit engine. Between 2011 and 2013, China used more concrete than the United States used during the entire 20th century. Entire cities were constructed before populations arrived. Local governments borrowed aggressively. Property developers expanded rapidly. Projects like Evergrande became symbols of debt-fueled growth. But China's credit expansion did not stay inside China. It fueled commodity supercycles, global manufacturing demand, luxury markets, and corporate earnings around the world. Global growth itself increasingly relied on expanding leverage. By 2019, global debt exceeded $250 trillion. The system appeared stable again, But underneath the surface, stability depended almost entirely on cheap money continuing forever. Then, COVID arrived. In early 2020, the global economy shut down, almost overnight. Flights stopped, factories closed, entire industries froze. Governments faced a terrifying possibility, a global depression. So they responded with unprecedented speed and scale. Stimulus programs exploded worldwide. Central banks injected enormous liquidity. Emergency lending facilities supported markets and corporations. In a single year, global debt increased by more than $40 trillion, more than entire decades of previous debt growth combined. At first, the response appeared successful. Markets recovered rapidly, asset prices surged, consumption rebounded. But the system had been flooded with liquidity. And when demand returned faster than supply could recover, inflation returned with force. For years, investors believed inflation was structurally dead. That assumption was about to break. For decades, markets assumed one thing: interest rates would stay low or fall further. That assumption broke in 2022. Inflation surged globally. Central banks responded with the fastest tightening cycle in decades. Borrowing costs rose sharply across the world. This marked a regime change. For 40 years, falling rates supported valuations. Rising rates reversed that mechanism. Higher rates pressure asset prices, reduce leverage, slow speculation, and stress models built on cheap capital. Governments faced rising interest costs. Corporations struggled to refinance. Real estate cooled. Duration-heavy assets came under pressure. A new macro reality emerged. This is where the key concept appears: the refinancing wall. A loan fixed at 2%, resetting to 7%, doesn't change spending immediately, but it transforms financial conditions instantly. Now multiply that across entire economies. Trillions in debt must be refinanced at higher rates. Modern economies rarely repay debt directly. They refinance it continuously. Rolling maturities, extending timelines, buying time. The system holds as long as refinancing remains possible. Global debt now exceeds $330 trillion. This debt must be refinanced over the coming years under far tighter financial conditions. The United States is approaching interest costs above defense spending. Japan remains above 250% debt to GDP. Emerging markets face pressure from higher rates and a stronger dollar at the same time. Yet global debt keeps rising. Because debt is now embedded in the structure of the global economy, governments rely on borrowing, markets rely on liquidity, households rely on credit. And reducing debt too quickly risks instability itself. Policymakers are trapped in a balancing act. Too low rates, inflation returns. Too high rates, debt stress spreads. Highly indebted systems rarely collapse abruptly. They adjust through inflation, currency debasement, financial repression, or weaker long-term growth. Which means the next decade may look very different from the last 40 years